Hello, everybody. John Blank, Zacks Chief Equity Strategist and Economist, here to speak with you on Monday, June the 2nd, 2025, about a 2025 list of winners that we have pulled together from Zacks portfolio construction effort over 4 sectors. So we have 16 sectors. This is a quarter of the sectors we look at. It's a variety of sectors. The finance sector will be part one. Part two will be the utility sector. Part three will be the transportation sector. And part four will be just one industry and sector, but a very important one, and one where you can find a lot of good stocks that are pretty safe, the business services sector. So let's get through this first. These are my views. I do have a PhD from MIT, and they are not necessarily the views of Zacks Investment Research. Okay, so first one. I pulled together for you two tables, the industry names here, the tickers, the market cap, and the industry codes. Of course, over here, we've got all the different finance industries, and here we've got all the different utility industries. So we rank them here by market capitalization, by the maximum number of analysts, and by the largest forward 1 month change in annual earnings. So these are ways you can pick a good stock as we've gone through. The same is down here, market capitalization, number of analysts, and largest annual change in earnings for the utility sector. So, of course, up at front, you're going to get Blackstone, BX, First Citizens, FCNCA, and American Express, ticker AXP. We did throw in the Qs here for the finance sector and for all of these sectors too, just to see if you just bought the Qs, could you have beaten the Qs by picking better stocks? The answer is only a few of these stocks do better than the Qs, but they do better than the Qs. You can beat them. Not true for the utility sector. You'll see get a lot of different names here. Detroit Edison, National Grid is a UK company. NiSource is focused on a different part of this business. So keep in mind, we're going to learn something about industries, that industries really are different, and you really do need to understand how they play out in terms of returns. Okay, so first off is the finance sector, and like I said, we will look for the tickers that are good. Number one, here's the Qs. Over the last 8 years, from 2017 to 2025, you could have earned 18% returns on the Qs. However, if you had bought Blackstone, you would earn 25% returns over the last 8 years. First Citizens, which is a roll-up of CIT Group and North Carolina Bank and other groups along with it, was just a big M&A roll-up, actually earned 23%. And American Express also beat the Qs at 18%. JP Morgan, just for example, was below the Qs. Well-managed bank, of course, we all know that. Berkshire was below the Qs. So you could have bought the Qs and done better than JP Morgan and Warren Buffett. However, truth be told, these are the three names that would have done even better than all of those groups. The answer is yes, there was. Now, Blackstone, I like the correlation matrix here. So we're in this industry, finance sector, and how much correlation is there? First Citizens, not a lot. But in general, 60 to 70% correlations with other banks and industries in their industry. So this is a tightly correlated situation where you're getting, Berkshire obviously doesn't have a lot of, it's a holding company of a lot of things other than finance. So it does show you that you lose some correlation outside of this industry. So again, looking at a portfolio construction, you were better off overweighting these prior names, and you could have gotten up to a 20% return with decent low risk at the same time if you had just picked these proper big stocks correctly. So this is probably exhibit A. If we go no further, look into this big stocks in the finance sector. By the biggest ones, the strongest ones, you would have beaten the Qs. Keep that in mind. I don't think many people would have thought that. And by the way, you would also earn dividends, and it would have been a lot less risky than otherwise. Keep in mind, that's what we're looking at here. Okay. Number of analysts, Progressive comes to play here. They earn 31% return. So, why did people cover Progressive and Travelers and all these other groups so heavily? Well, now you know. There was a lot of people interested in Progressive because it made a lot of money. And Progressive, look down here, you can see much lower um, correlations here in their industry, much lower than the finance sector. And of course, over here again, if you pick the best names, you did much better, and frankly, with a lower risk. So it really does matter. That's why I've talked about the top tickers to get into the right names. It does make a difference. There's no question. All right, forward change in estimates for this industry. Look at this, negative estimates. So these were just picking up changes from poor estimates to better estimates of underperforming banks. This was not a good use in the finance sector. Keep that in mind, in the finance sector. And again, looking at this ticker, UBS, which is, as best as we can, that's the Swiss bank. Again, you're seeing, slightly less correlation, probably because a lot of this is a Swiss bank and it's got some lower correlation because you're introducing the FX rate of the euro and the Swiss franc. Okay, again, picking the better stocks made a better choice for you in terms of portfolio performance, and it frankly did not deliver higher risk. It returned lower risk. So again, this is just classic example where actually picking the better stocks does matter a lot for your portfolio, for your returns, for your risk. Okay, final one. All three criteria. Let's look through these names again. Blackstone, First Citizens, American Express, Q's, and Progressive. Those are the names you wanted to play in. Again, keep in mind, here is the Blackstone correlations. They're highly correlated. And here is the proof you need that picking better stocks, took you over the last 8 years to 380% return from 290% return. It was substantially different and better. All right, now to the utility sector. Of course, this is a defensive sector. What did it buy for you over the last 8 years? First off, Vistra, the Texas, utility that people have bet on to provide data center power, was the true clear winner at a 33.5% annualized return. It made 910% over the last 8 years. So that was just phenomenal. But look at all these other returns. They're not very good. 7%, 9.8%, 2.5%, 1.3%, even negative. So you got to keep in mind that there was only one play in the utility sectors that really benefited you. And if you own that play, you basically got a decent portfolio return. Now, NGG here, we can look at their correlations. You can see they're much lower than the banks. Down in the twos and the threes. Some of them are up close to 5 and 6, but in general, much lower correlations because these are regulated industries, don't really compete with each other, don't really get tracked each other either. So keep in mind, like I said, industries really do matter here. You can see only Vistra was your play. All right, compound annual growth returns. I just want to point this out. You say defensive, but in truth, all you're earning is, somewhere between 2 and 9% annual returns on utilities. And you're getting Detroit Edison here, you're getting a Duke and, things like it, super tight correlations, but down below here, not so close to correlated. And of course, you got to pick the better names. There was here, of course, lower risk than the finance sector, 4s versus 6s, but you got much lower returns with much lower risk. So problem here is lower returns and lower risk were substantially lower, and the risk was not substantially lower. So relative performances here really talked to me, and I think they should talk to you. We've got a lot of generalized understanding of finance, and it doesn't play out when we look at it in terms of actual industries. Largest forward 1 month change. Well, surprisingly, this was the tool. It was not the tool in finance, but it is the tool in utility. Look at this. All of a sudden, we're getting into 11, 13% returns. It was picking up utility groups that were performing better. That is fascinating. Keep that in mind too. Sometimes largest banks mattered most, a lot of scale and scope here, but in the utility business, the better stock was actually picked up by the forward annual earnings estimate change. So businesses that were running better were picked up here, and they did get you stronger returns. And frankly, at a much lower correlation here. Look at this. The standard deviation is much lower than he might be. Obviously, much higher than all the other picks, but you got a much higher return too. All right, like I said, Vistra was the play. There was no doubt about it. And if you picked Vistra, you did much better. All right, transportation sector. Of course, air and others is all that's here, and business services is just these groups. Again, just look at the tickers and the names here: Visa, MasterCard, Fidelity National, Cintas, Coherent, Waste Management, WM. EXL service, you probably don't know that. We're gonna talk about that. Pentair, WEX, and Iron Mountain, ticker IRM. These are big cap stocks. This is a really attractive business to know about from a stock owner perspective. And of course, here we've got a lot of the rail performers in 58, right? These are all the Canadian Pacific, Canadian National, CSX, yeah, Norfolk Southern, Union Pacific. And up here, you've got different variety of air transportation groups. GE Aerospace is in here because of their aircraft engines. But they're very different than the other ones like Delta, United, and Union, FedEx and UPS. Again, by coverage, pick up a lot smaller names, and by number of 1 month's change in estimate, you're going to pick up names that are actually very interesting, like Azul and Copa. They are outside the United States. That's what happens here when you look at this use. Again, it all depends on what industry we're in. So let's throw the transportation sector. Number one, GE returned a 7.8% annualized return. It was not great. You could do much better with holding just a few of the big names in rails. All the, getting rid of the worst performer, Canadian National, keeping the other four would have done wonders for your portfolio. So to no surprise, since there was such a strong correlation and return performances for the railroads, because they're also similar businesses, you actually got an equal weight portfolio rating here. So the interesting thing here is we talk about industries, but when they're so similar in terms of their internal structure, there really is no difference in returns that's material, and you're better off just owning all of them. So that's the big takeaway from the transportation sector. Again, the real big names were in the number of analysts. Saya and ODFL were picked up. They are trucking firms, and they turned out to be better than the Qs, 24% and 25%. So that is fascinating because during COVID, if you'd run through these, they obviously got destroyed, but they returned so well. So again, this is another lesson that, looking into the number of analysts in this industry, since there was nothing of real interest at the market cap level, Old Dominion and Saia, which are less than truckload trucking firms, were really the plays, and they did beat the Qs. Now down here we've got Southwest Airlines, that's ticker 11. You can see again, you're getting anywhere from 40 to 60% correlation with this broader industry, which should not surprise you. Again, here, if you picked up Old Dominion and Saia, you did better in returns. So these names were worth knowing about. Keep that in mind. We're talking about the COVID period when there was trucking that was doing well. That's fascinating. I don't think any of us would have thought that. But again, it's the buy and hold story. You can own these big stocks that are right because the analysts are covering them and you're picking up better returns. Okay, forward 1 month change. I picked up two names you probably may not know that are doing real well: Frontline and Matson. Frontline is a shipping company, seaborne crude and other products. It's based in Hamilton, so it's a shipping company. And Matson does Hawaii. It's an old school Hawaiian shipping company that has also done quite well. Again, you beat the Qs if you own Frontline or Matson. So yes, you can beat the Qs. Over here, we've got Azul. I think they're down in Latin America, and you can see here there are much lower correlations with these groups because there really are different businesses. The correlations, kind of talk to the internal similarities or differences between companies within an industry, and then correlations are high, businesses are kind of similar. When they're low, they're not so similar. All right, so the characteristics. Here's Union Pacific. You can see CP and CSX and Norfolk Southern. 70, 80% correlation, so even higher than the banks. That tells you what you already know, that banks are a little more diversified and a little different in structure than these big rail firms. However, Old Dominion, Saia, of course, these less than truckload names were the real plays, and your real story was to just stay equal weight in this business. All right, one last sector, very clean play, businesses, services. And what we have here is lots of good names that beat the Qs. Visa, MasterCard, Cintas, Waste Management, EXL Services, and Iron Mountain. All of these names, six of the 10 names we're looking here are beating the Qs. I mean, really, think about that. And think about how many people thought the last 8 years that business services, good business services names, six big good services names were going to beat the Qs substantially over the last 7 or 8 years. That is not wisdom that you heard in the marketplace. It's definitely true. And down here you can see Visa's correlations. Obviously 90% with MasterCard, but 50, 60% with some of the other names, and then the things that were not financial related were down in the 30s and 40s and 50s. So lower correlation, higher return, and much lower risk. But this is what I'm talking about. You could have picked up these six names in business services, done much better. 20% annualized return was much lower risk than the banks, much lower risk than the Qs, and much higher returns. Now, who has ever told you this out in the marketplace? That's why we do these things. That's why this is useful. So if you need these slides, please, thanks for coming and give us a call. You can use these to get us a hold of us and talk to us. First of all, number one, call us 866-794-6065, and you can get these slides. Send us an email, strategycall@zackspro.com, or find us on the web, www.zackspro.com. We also have a LinkedIn page at Zacks Professional Services, and we can be on Twitter, putting up tweets at ZA Tools. Best thing to do, of course, send us an email, strategycall@zackspro.com. Strategycall@zackspro.com. You'll get these slides. These slides are what we do these things for, and this really does deliver value. I think I can prove that today very well. So hopefully, like I said, these are the 2025 winners for portfolios construction, and I'm sure you probably did not think you could beat the Qs with the business services and major banks before this talk. Now you know. That's really helpful to know. I obviously looking forward for 2025 on. It's a different world. Will be different things, but there's something to be learned from all of this going back over the last 8 years. I hope you enjoyed it. Thanks.